A shockwave rippled through markets on February 24 when Russian tanks rolled into Ukraine, beginning Europe's largest land war since Germany invaded France in May of 1940. The Russian economy is in freefall, European stocks plunge into technical correction territory, and whipsawed US markets, which are still in the black for now, are facing spikes in energy prices that may indicate a recession. It is impossible to predict the outcome of the next few months with no end in sight to the invasion and the world's fate seemingly in the hands of just one man, Russian President Vladimir Putin. Hello everyone and welcome back to the Finance Guardian channel. Now in this video, we'll take a look at how wars affect the economy and stock markets. Subscribe to our channel, click the bell beside it, and let's get started. Historically, stocks have largely survived geopolitical conflicts according to the LPL Financial Research. Despite how serious this escalation is, previous experiences suggest that it is unlikely to have a material impact on U.S. economic fundamentals or corporate profits, said John Lynch, former LPL Financial Chief Investment Strategist, referencing the January 2020 U.S. airstrike that killed Iranian General Qasem Soleimani. He added that given that stocks have weathered heightened geopolitical tensions before, they wouldn't be sellers into weakness related to the event. World War II started in 1939 and ended in 1945, and during that time, the Dow achieved a total gain of 50%, over 7% per year. The U.S. stock market rose a combined 115% during the two of the worst wars in modern history. It's not as easy as it seems to understand how geopolitical crises affect market outcomes. Another example is when Russia invaded Ukraine on February 24, 2022, which shook global markets. Although tensions have been rising between Russia and Ukraine for years, the current military action has increased the chances of a protracted conflict within Ukraine and created concerns about the potential impact on the global economy and financial markets. The good news is that while geopolitical crises like the one between Russia and Ukraine can temporarily roil markets, they do not usually cause long-term damage to investors. Crises of this kind generally do not have a significant and lasting impact on global financial markets unless they have sustained macroeconomic implications on major economies. According to the International Monetary Fund, Russia's economy ranks as the 11th largest in the world. It is only about 1/20th the size of the United States and 1/15th of China, so it is unlikely to affect global markets or economic growth alone, even if sanctions imposed against it by the United States and Europe are severe. However, the conflict poses risks beyond the two countries' borders as Russia supplies 10% of the world's energy and nearly 50% of the energy consumed in Europe. These risks include higher energy prices and an increase in volatility in the financial markets. Besides causing market volatility, the invasion has the potential to increase inflationary pressures by interfering with oil, natural gas, and wheat exports from Russia and Ukraine. There is likely to be a difference in the impacts of the conflict based on geography. European countries, especially those such as the Baltic states and Poland, are likely to experience more difficulties than countries less dependent on Russia for energy. Winter heating in Europe is provided primarily by Russian gas, and already spiking prices are causing problems for European households and businesses. Similarly, Western Europe, particularly Germany, does not have any easy alternative sources of energy to replace Russian natural gas. The Russian-Ukraine conflict adds to the uncertainty surrounding the expansion of Europe's economy. It does pose some uncertainty to global markets, but the U.S. economy appears to be relatively unscathed. The effects are most likely to manifest as additional inflationary pressures due to higher energy prices among consumers and investors in the United States. Russian stocks, bonds, and the currency are the most affected from an investment perspective. North American energy companies, whose stocks have been among the best performers in the past year, could further benefit from higher oil and gas prices. It is likely that stock market volatility will increase over the short term. The Russian military action could also exacerbate general market nervousness. The recent volatility in the stock market reflects investor concerns, so adding another source of uncertainty and disruption is unhelpful. Nevertheless, additional inflation pressures and higher volatility by themselves will not cause a recession in the United States. While geopolitical risks may interfere with investment decisions, U.S. investors shouldn't overlook the long-term potential that international stocks may provide. International stocks are expected to outperform U.S. stocks over the next 20 years. In part, this can be explained by the fact that U.S. stocks have risen more than other countries' stocks over the past 2 years, and that U.S. stock valuations are now high by historical standards. Professional management and diversification can help manage short-term risks while pursuing long-term returns. One must hold stocks and bonds across many regions, countries, sectors, and industries. Due to the diversified approach, you are generally not exposed directly to investments in Russia and even less exposure to those in Ukraine. That level of diversification can give investors some peace of mind in the face of geopolitical events. The other side of history tells us that periods of uncertainty such as the one we're experiencing now typically lead to stock market declines. According to a 2015 study conducted by the Swiss-France Institute on U.S. military conflicts after World War II, whenever there is a pre-war phase, an increase in the chances of war tends to decrease stock prices, but the actual outbreak of war typically increases them. However, the outbreak of war reduces stock prices when it starts as a surprise. There is no clear explanation for why stocks rise in a war setting after a prelude, a phenomenon they call the war puzzle. In another study focusing on the period from 1926 through July 2013 by Mark Armbruster, president of Armbruster Capital Management, he found that stock market volatility was lower during times of war. On the surface, one would anticipate that the geopolitical uncertainty would spill over to the stock market. However, this has not always been the case aside from the Gulf War when volatility was roughly in line with historical averages. However, regarding the Iranian conflict, investors have reacted mutely to the headlines. Strategist Technical Director Todd Son said to the Washington Post, "If 2019 taught us anything, it's that you have to try as best as possible to keep your process and not get caught up in the headlines. In a sad way, I wonder if we've become used to it. I wonder if the market has learned to discount these events." One reason for the calm may be the changing structure of global oil markets and the decreasing vulnerability of the U.S. economy to changes in energy prices. Part of the reason may be purely psychological. Today's investors have witnessed the stock market recover from 9/11 and the Great Financial Crisis, arguably the two biggest geopolitical and economic shocks of our time. As a result, other unforeseen events are less likely to derail investor confidence. As Russia is a crucial producer of crude oil and natural gas with pipelines that serve many parts of Europe, a broader conflict with Russia can also cause volatile oil markets. It is possible that higher energy prices would result if Russia shut off the spigot or suffered significant damage to its oil infrastructure. The interruption of ports around the Black and Baltic Seas could create even greater shipping problems as grains and other staples remain at sea, resulting in food inflation. Beyond the heavy human toll, war has severe economic costs as well, such as damage to infrastructure, a decrease in the working population, inflation, shortages, uncertainty, a rise in debt, and disruptions to regular economic activity. Some perspectives suggest that war can be beneficial to the economy in terms of generating demand, job opportunities, innovation, and profits for business, mainly when the war occurs in other countries. However, we must be aware of the broken window fallacy when we speak of wars as economic benefits. When we spend money on war, it creates demand, but it also represents a huge opportunity cost. So instead of building bombs and restoring destroyed towns, we could have invested this money in education or healthcare. Two factors have in recent years conditioned markets to not overreact to political and geopolitical shocks. First, the belief that there won't be a significant escalation of the initial shock, and second, the belief that central banks will effectively contain financial volatility. However, investors should use an overall selective strategy when purchasing dips. This means emphasizing trades anchored by strong balance sheets and high cash flow, avoiding large-scale shifts away from U.S. assets to international investments, and reducing exposure to inherently less liquid market segments that have experienced positive spillovers from extraordinary central bank stimulus. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, welcome to the channel. Please do subscribe to remain updated about all of our future videos. We'll see you next time.